So here we are waiting for another inflation report from the United States. One must note that too much attention is being paid to the month-to-month oscillations in the interest rates and inflation. Rather, the big picture mega forces portend expensive money for an extended period of time. Perhaps, as regards projections for the interest rates are concerned, the issue is not higher for longer but higher forever. On Wednesday, while only a monthly reading, the United States reported a 3.5% increase in consumer prices for the year to March. This figure was high enough to chill the idea of several Fed rate cuts in 2024 that had been telegraphed by the central bank and assumed by many financial investors worldwide. Over the past 6 months, the S&P 500 has gained nearly a fifth or 20%. More interestingly, the high-yield credit spreads have narrowed from 500 basis points last year to about 300. The United States jobless rate remains below 4%, while hundreds of thousands of jobs a month continue to be added. So that's a very robust job market in the US of A. It was unclear if sustained high interest rates would necessarily necessitate a recession, particularly if the government spending remains elevated. Now, interest rates could toggle between 2% and 8%, generally speaking. Now, what are the main causes and why is this inflation so stubborn? Military spending, reshoring of industry, and the energy transition could promote higher price levels for quite some time. As such, short-term monetary policy responses may prove to be inconsequential. So far, in 2024, companies have wisely raced to refinance debt during this favorable window. The $600 billion of bond issuance through the first quarter reflects a 40% increase from last year. In fact, the rush is to beat election volatility, but these borrowers have conveniently been able to jump in before the views of pessimists become ingrained. The 10-year treasury remains elevated at approaching 5%. As such, even with tight spreads, the cost of borrowing is still allowing healthy returns to lenders and bondholders. It is also not sparing the weakest of the pack. Total commercial Chapter 11 bankruptcies in the first quarter were up 43% from 2023, according to Epic Bankruptcy. The underlying question of extended above target inflation is if failing to return to 2%, the target rate is harmful. Consumer spending remains healthy. Anyone who wants a job has one in the United States, and companies with decent prospects can raise capital. If that is sustainable, then Jeremy Powell may not have to cut rates to claim victory either. But yes, Joe Biden may need to cut interest rates if he was to claim victory in the presidential election, which is about to ensue later this year, 2024. So where does the catch lie? Is the victory of Jeremy Powell not to have to cut interest rates to maintain such a robust economy? Or is it Joe Biden having to cut interest rates to increase his chances of winning in the presidential elections in November? What have it? Please do join our Prime or Prime Plus groups, which are addressed to the US markets. For the Indian markets, you can join our Guri Parva package, which gives you daily predictions, or the Premium Value, which gives you 1 week predictions in advance. For both, you can WhatsApp us on 982-086-1044. You can also email us at globalmoneyinvestor@gmail.com. globalmoneyinvestor@gmail.com. Happy investing and have a great investing day ahead. Take care. Bye-bye.